Welcome to the deep dive video update. And I always want to explain this. My context of deep dive is probably a little different, so I want to explain this right off the bat. Every week, I look through hundreds and hundreds of charts, and I pick out those charts that are really talking to us right now, and I include those in the various videos that I do. Well, then I go back and I look at all of the different charts, and I pick out the ones that I really didn't use very often, and I put them into this video. And the reason why I call it a deep dive is we have to look deeper into these charts to see if they're still telling us something, even though it's not really blatant at this time. This is being prepared for Monday, July 29th. I do have a thing called the SPX investing program. If you want to learn more about that, there is a link to some videos in the description. There's also a link that will take you to the website. It's free for right now, but I'll probably be locking it down in August. And here's an email address if you would like to talk to me about it. Also, the video that you're watching right now is just one of the weekly videos that I do. The main foundation of my analysis is the daily videos. So if you really want to keep track of what's going on, tune into the daily videos. That's where you get day by day, step by step analysis and commentary to see things developing or to see things that maybe we would miss otherwise. The first chart that you see here is a chart of the VIX. This measures the range of the VIX by using a 50-period exponential moving average. The VIX itself is on here, but invisible. As we've been coming up out of the lows set back in 2022, we've been seeing where the VIX itself is going into a lower range compared to other times. And that's typically what happens when we're in a bullish or upward trending market. We ticked up just a little bit here as the market's been a bit under pressure, but mainly what we use this for, not to make decisions, but just to get a big picture look at how is the VIX actually reacting. Then we take another study of the VIX and we use a thing called the VVIX, which is the volatility of the VIX. And we do a ratio between the two. In a general sense, when this is going down, that is more positive for stocks. When this is going up, that tends to be more negative. But you can see there are times when this was going up and stocks were going up too. So that's not a hard and fast rule. We are starting to turn up a little bit now as we're seeing volatility picking up lately as the market, especially the NASDAQ 100 and the S&P 500, have been under some pressure. We also look at the volatility of stocks as measured by the VIX, and the volatility of bonds is measured by the MOVE index. And again, as a general rule, when this is going down and I follow the red moving average line here, that tends to be more positive. It doesn't always mean that, because here we were going up in earlier 2024, but the S&P was also going up. So it's not a cut and dry type of thing here. We are seeing this start to turn back up as we're seeing volatility coming back into the market. And then just to know where are we in reference to the previous all-time high that was set in early January 2022. And based on Friday's close, we are 13.29% above the previous all-time high. Then stockcharts.com has this thing called technical alerts, and I usually go through them every day. What you see here are the alerts for the whole week. And typically, if we have an up day, you're going to see it either blue or green. If we're having a down day and bad things are happening or negative things are happening, you're going to see an awful lot of red. It ends up looking like a Christmas tree here. I just look at this in the total just to see, okay, we're seeing a lot of red, that's negative. We're seeing a lot of blue or green, that's positive. I actually break down these alerts as they happen in each daily video. Stockcharts.com has this other thing called technical scores. The idea behind technical analysis is not only to see what's going on, it's to try to remove as much emotion as possible. Because if you trade by your emotions, you're going to be right just enough to justify that maybe you know what you're doing. You know, you go off a hunch or I got this feeling, baby. You know, that's gambling at that point. Well, even when we use technical analysis, there's still emotion that can go into that. Stock Charts has tried to take this a little further by saying, okay, let's take these technical indicators, put them on a chart, and then score it from 0 to 100. The higher the score, the better looking the chart. That can be applied to a stock. It can be applied to an index. It can be applied to a sector. I use it here to plot it against 5 different indexes, the main indexes that I follow: the S&P 500, the Dow, the NASDAQ 100, the mid caps, and the small caps. And believe it or not, which is probably not really all that surprising lately, we have the small caps is represented by the IWM. That's the ETF for the Russell 2000 Small Cap Index. It is coming in first place at 96. It is the best technical score right now. Now, not too long ago, back in June, we were under 20. We were down into the teens. And since that time, we hit July and we've really started to see an improvement here. For much of 2024, this has been the worst performing index. Now, this week, it's the best performing index. We'll see if that can continue. In second place are the mid caps. Now, earlier in the year, the mid caps were doing well. Then they started to not do so well. Now they're starting to improve again. They're coming in second place at 83.9. In third place is the Dow, which had been lagging a bit, but this past week, some earnings reports came out, and that really helped push the Dow higher. The Dow was only 30 stocks, where we have 503 stocks in the S&P 500. And so you get 1 or 2 companies that come in with positive earnings that are considered the best of the best companies that make up the Dow. And that can really help improve the overall score to 70.2. Then in fourth place, which had been in either, well, usually second or third place for most of 2024, is the S&P 500 coming in at 70.1. Now, the reason why this is seeing some weakness right now is because the mega caps and the big large caps and the semiconductor stocks, those are inside the S&P 500, but there are 503 stocks in the S&P 500, so it's more balanced. And so even though it's been under pressure lately, it hasn't been going down as much as our last place index, or the QQQs, which have been in first place for most of 2024. See where we were up here into the 90s for long periods of time here, because that was the mega caps and the large caps and the semiconductors that were really driving the NASDAQ 100 higher. Well, we're seeing a shift. And so far, it looks like that shift is continuing, going from the large mega caps over into the small caps. And now this is negative in the fact that we've been seeing the NASDAQ 100 and the S&P 500 under some pressure, but it's positive in the fact that it's not taking money out of the market. It's just shifting money from one area of the market into another area of the market, and that's what we call rotation. But now, as this process has been taking place, the Qs have gone from being the strongest index now this week to being the weakest index, coming in at 41.1. Then some short-term charts. This is a rainbow, and the reason why this is short-term is it goes from 10 periods up to 50 periods with simple moving averages. The colors change down here to kind of make it look a little cool. And we're seeing the short-term trend threatened right now, where we've come down actually to the bottom of the rainbow. Now, my definition of a positive or negative short-term trend is when we're above or below the 20-period simple moving average. We've dropped below that, and we've also dropped down below the bottom end of the rainbow as well. The longer we stay here, the more we're going to see these lines start to roll over and actually go down. Then we also have a thing called the boom indicator. This measures how far is price above or below a moving average. And I have a 20-period moving average, 50-period moving average, and a 200-period moving average. And when we get far away, when the price gets either way above or way below the moving average, it has a tendency to snap back like a rubber band, or the moving average acts like a magnet to bring it back closer. And we can set that up on a chart like this and use it like an oscillator to see when we're extreme positive or negative. Well, we're dropping down and actually starting to get somewhat extreme negative here on our distance away from the 20-period moving average. That's negative in and of itself, but we could still go lower than this, which would make it even more negative. Then the 50-period moving average, this is turning a little more negative too, because we're actually dropping below zero. It's going from being positive to negative now as we're dropping below the moving average. And as of Friday's close, it was kind of interesting. In Thursday's session, we closed under the 50-day moving average. In Friday's session, we were able to close back above it. And we're kind of right at that point right now. And this is the line in the sand in the intermediate term to determine if we're positive or negative. When we look at the 200-period moving average, we are declining, but we're still well above zero. So this is still positive. Then we have another intermediate term rainbow going from 50 periods up to 100 periods. We're coming down. but we're just coming into the top part of the rainbow because the first moving average here is the 50, and that's what the market's currently dealing with. So as long as we stay above even the high end of this rainbow, these lines will continue to go up and suggest that the intermediate term trend is still positive. If we see more weakness and start coming down into the rainbow, that's going to suggest more intermediate term weakness. And we want to keep an eye on the 100 period moving averages. Now I'm following the 20 and the 50 right now in the daily videos. I haven't been showing the 100 because we're still well above that for the time being. If we end up dropping below the 50 period moving average, the next line in the sand that I watch is the 100 period moving averages there. Then I added some things here with the anchored moving averages. Now, regular moving averages, let's say it's a 10 period moving average. It takes the last 10 periods, adds them all up, and then divides by 10 to get you the average price. And then on day 11, day number 1 falls off and day number 11 is added. So it's moving along as new prices are being calculated into the overall moving average itself. Well, we have another thing called an anchored moving average, where you go back to a high or a low, and then that just extends forward from that price. And I wasn't really showing this very much with any of these new lines in here because we kept going up and up and up and up. Well, now that we're seeing some pullback, the drop that we saw back in April that started to bounce in May, here's an anchored moving average going from that point, and we've already fallen below it. Now there's another drop, and this was a more significant drop earlier in April, and we are still above that. And then going back to the October lows, there's another anchored moving average there. If we continue to fall, we'll be seeing if any of these areas end up providing some kind of support. Then we measure the distance above or below the 200-day simple moving average. Even though we've been dropping back, we're still over 9% above the 200-day simple moving average here. So that's positive in the long term. And then just to take some approximate measurements here, I go from the October 2023 low up to the close on Friday, and we're still up 24.75% from that low. Now, I do this and I kind of have to eyeball it. That's why you might see actual numbers that may vary as far as the percentages. Then we have a thing called the CMB Composite Index. This is supposed to be a standalone trading system, but I don't use it like that. I use this like an oscillator. And earlier in July, when we were screaming to the upside, we were getting extreme positive readings. Then as we wore that off, now we're seeing some pretty negative readings, but not enough to actually drop below this black line. The thing to notice from this is I put these black lines on here. I just kind of take a long-term look at this indicator and I go, okay, that's a pretty good range for the top and that's a pretty good range for the bottom. I try to put them around numbers that make sense. So there's nothing magical about these black lines, but they're just warning signs to us. And we use this with other indicators to tell us when we're extreme positive or negative. Then there's another oscillator called the Connors RSI, and this thing really gyrates all over the place from day to day, but it doesn't give us extreme positive or negative readings very often, and it's not giving us one right now, so I haven't been showing it. The mass index, this is not generating a signal right now. We pay attention to this when the line goes up to the red dash line and the blue line and then ends up dropping below it and then going below the red dash line. Sometimes that will suggest a reversal in the trend. And since we're not even near those lines, there's been no need to show this chart. The percent B indicator, and there are a lot of different ways to implement Bollinger Bands. One way that I do is using the percent B indicator. This measures when we close above or below the upper or lower Bollinger Band. And we did a little while as we were really screaming to the upside. We did back in June and then again in July. Well, we've since that time dropped below the midpoint, which is turning things a little bit more negative. And when we drop down below the midpoint here, that actually turns this more negative. But we haven't got down to the point yet where we're seeing this extreme negative right now. Then we compare the S&P 500 with the S&P 100. It's the S&P 100, the bigger stocks that make up the S&P 500, that have really been driving both indexes higher. Now we're seeing them diverge a little bit with each other, where the S&P 500 is holding up a little bit better, where the S&P 100 is coming under a little bit more weakness. And that's being confirmed by what we see in other charts as well, with the QQQs and some other studies that I do. Then this is just two different charts taken together here. we look at the highs minus the lows for the S&P. Now, this really jagged line here, that's just a daily score. And then over top of that, I put a 50-period exponential moving average. Down below, that's that same moving average where it's a little bit easier to see. And we are still positive overall, even though it's really hard to see, but we're starting to turn down just a little bit with this particular indicator. This is that same indicator, but shown with a little bit different colors and so forth. When we're above zero, that's positive, even though we have been falling back and we're starting to decline slightly here. A long-term rainbow goes from 50 periods up to 250 periods. We're just coming into the top part of the rainbow, which is a 50-period moving average. So all of the lines continue to go up. That still means that the long-term trend is still positive. Then we look at another long-term oscillator called a special K, and this is a daily chart where we're above the red line, and we crossed way back in November of 2023, and we've been positive ever since. I don't show this chart because we don't get very many signals from it, but it remains positive as of right now. Then we look at a weekly chart of the S&P on top and a weekly chart of the German DAX in the middle area. And a lot of times they have a pretty strong correlated relationship with each other, but that seems to be waning lately, meaning that they're not really correlating all that strong. Sometimes we look to the European markets to get some clues as to what may happen, either positive or negative in the US market. That's not really helping us right now with this weekly chart. Then support and resistance. I don't have any charts to show you because I've been pulling those out and using those in the daily videos. So we look at some broad market measures where I talk a lot about the VIX. That measures the volatility of the S&P 500. The Vixen measures the volatility of the NASDAQ 100. And we have been picking up as the NASDAQ 100 has been under pressure lately. Then we do a ratio. We look at the S&P on top, and then the ratio of the Qs, the NASDAQ 100 to the diamonds, which is the Dow, and then do a correlation between them. And we're seeing that the S&P and this ratio are also having a strong tendency to go in the same direction. And then we've been keeping an eye on transports. They've been a real disappointment, really lagging behind. But since we're seeing this rotation and this shift and possibly switching to a lower interest rate environment, the transports have been picking up. Now, they have a lot of work still left to do, but we're just keeping an eye on that for right now. The black line that you see here is the Dow, and the red line are the transports. I have a couple of rate of change charts, and I only show them in this particular video. This goes back 250 periods where we are seeing things declining just slightly. And then another look where we came up to this blue line, and I pointed this out at the time. There's nothing magical. I put the blue line on here, but sometimes when we get at or slightly above this level, that can point to some kind of exhaustion. And at least to right now, it looks like that could be a possibility. And we keep an eye on bonds where we have the long-term bond ETF in blue and the S&P, which is in red. The correlation on a longer-term basis, even though it's dropping off slightly, is still fairly strong. And then we look at the shorter-term correlation where, again, it's weakening a little bit and not really, really strong, but it's still fairly strong for the time being. So that's why we keep an eye on the bond market. If bonds are going up in price, that means they're going down in yield, and that tends to help stocks. And we look at the QQQs and then that same TLT, the long-term bond ETF, and we see kind of the same thing here where they have it's, even though it's dropping, it's a fairly strong correlation between the two. So if bonds are going up, interest rates are going down, that often will help the QQQs, which are the NASDAQ 100 stocks. And we have, this is kind of an interesting chart. We look at the 10-year yield in the US and we subtract the 10-year yield in Germany. And since US rates are higher, we're above zero right now. And then we plot the US dollar index down below, and we see the interplay between interest rates, not only in the US, but internationally, and its impact on the dollar index. And right now, these charts are having a fairly strong correlated relationship. That's why we keep an eye on this to see if that correlation continues. The stock market tends to like a weaker dollar, and the official stance of the U.S. government is that we have a strong dollar policy. The unofficial stance of the U.S. government is that we have a weak dollar policy. And because it's more advantageous for conversion purposes, for import and export relationships that go back and forth, stocks tend to like a weaker dollar. It makes their earnings look better. Then we keep an eye on the yield curves. I look at the 10 to the 2 year and then the 10 to the 3 month. These are the two most important, in my opinion, with most people probably following the 10 to the 2 year. They're still inverted right now. They're under the red line. What we're going to be watching for is to see, are these going to go back to being above the red line, being uninverted, or actually going back to normal, where it's been over 2 years now with the 10 to the 2 year and almost 2 years with the 10 to the 3 month. We're watching the employment situation. That's kind of the last holdout. If we start to see weakness in employment, and we're going to get the employment situation report this coming Friday, and that shows some kind of a trend, not only beyond this coming Friday, but going forward, we might see these yield curves going back to being normal. And then that's usually when we start a countdown to see, are we going to go into a recession? It's usually about 6 months on average. It could be 2 days, it could be 8 months, it could be 15 months. We don't know. We're just looking at averages at that point. And of course, everybody has an opinion about it. But what we do is we look at the charts and say, okay, this is what's happening. We just want to be aware of it. Then the market is still anticipating a soft landing, meaning that we're not going to go into a recession. But as there's been a shift going on in the market, we're seeing that this ratio between the S&P and 3 to 7 year bonds is showing some weakness right now, but not necessarily a reversal. We've dipped down into this rainbow before only to bounce back up and recover. What we're going to be watching for to see, are we seeing more follow through weakness? Are we going to actually see a change in the overall climate to where it drops down below the rainbow and the rainbow starts to turn over? That's not happening yet. So we're still anticipating a soft landing, meaning that we're not going to go into a recession. Then we look at 1 to 3 month T-bills, which you could pretty much call cash. We compare them with 3 to 7 year bonds. When this ratio is going down, that means that interest rates are probably going down and that there's not a lot of inflation risk. Well, that's kind of what's happening here, and we want this to continue. Now, as we've been really watching this rotation out of the mega caps and into more mid caps and small caps, or what some people call the SMID caps, I haven't been as focused on this, but I still look at these charts every day. We want this ratio to go down if we're more positive on the market and we're more certain that interest rates are going to start coming down and inflation is going to continue to decline as well. This chart also kind of says that same thing. It looks at TIPS, which are Treasury inflation protected securities. They outperform when inflation and interest rates are going up. They go down on this in this ratio when inflation and interest rates are going down. We are a little bit concerned because we're in an uptrend here, but you can see how it's been falling back recently. We want this to continue to fall if we're more positive about inflation going down and interest rates going down. This is that same kind of thing here, but looking a little further out. TIPS was 7 to 10 year bonds. This previous chart was 3 to 7 year bonds. So we're going further out here. And this is also declining a little bit, but it's still in a longer term uptrend. We want to see this continue to fall to show that the inflation worries and expectations are actually starting to decline. And then we look at 1 to 3 month bonds, 1 to 3 year bonds and 3 to 7 year bonds. We want to see this ratio continue to go down. When we're in a rising inflation and interest rate environment, that's when we see this ratio going back up. We want this to continue to decline if we're more positive. And then we look at a ratio between the Qs and the 3 to 7 year bond. And the Qs have been really outperforming for most of 2024. Now this is starting to show a little bit of pressure at this point. Are we going to be able to bounce up out of this and resume this uptrend, or are we going to start to see some more weakness develop? And we compare Euro stocks with American bonds, and just to get an idea of what's happening here. And we're still kind of down in the rainbow here. There was some uncertainty about the French elections, then the UK, which is not part of the EU anymore. They had an election there. Now we've got the Olympics going on in France and just all the craziness that Europe has to deal with. And that's been pressuring European stocks compared to American bonds. So we're coming back down a little bit here into the rainbow a little bit more. Then I have a thing called possible positive scenarios, and these were really helpful back in 2022 when we were more or less in a downtrend at that point, and then it looked like we were going down pretty far, pretty fast, and we might have some kind of a bounce. Well, those charts are still pretty helpful even on a day in and day out basis, but I don't use them every day. The other charts that I don't use every day are what I show here in this video. This shows the percent of stocks in the S&P 500 that are above their 200-day simple moving average. Now, I have another chart that does the same thing, but I use it in a slightly different way. This one is used more like an oscillator. When we get an extreme positive or negative reading, we're not getting that right now. And when we're above 50, that's more positive than when we're below 50, when that tends to be negative. We're still positive for right now, but we're not getting any kind of extreme readings. We use that same basic idea and measure the stocks in the S&P that are above their 50-period moving average. We're still above 50 now, so that's remaining positive. We're not getting any extreme positive or negative readings. And then we look at the mid-cap stocks where they're showing some improvement and above 50. And then the small caps, which are actually looking kind of the strongest right now, where they had really been lagging earlier in 2024. So thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. Have a great weekend, and I will talk to you in the next video.